Hello, everyone. Welcome back to another installment of our Lunch and Learn webinar series. I'm your host, Mayur Thaker. I am an equity strategist and at Zacks Investment Research. And today we're just giving an important update on several important aspects of the U.S. economy and the data that I'm seeing that is suggesting that there is mounting evidence of a recession here in the U.S. and therefore lower stock valuations. So let's get right into some of the data that I'm seeing here and exactly why I'm thinking in that way. And just as some housekeeping, just a quick disclosure, these views are my own and not necessarily that of Zacks Investment Research. Past performance is no guarantee of future results. And this material is being provided for informational purposes only. So let's take a look at some of the data that I'm seeing here. So, as we all know, this has been an ongoing issue all year long, that the bond market remains firmly bearish with Treasury yield spreads inverted. We know this from the spread between the 10-year yield and the 2-year yield, which is the main spread that I'm watching. I believe that one is the right one to see because of its exceptional track record over the past 50 years at, getting ahead of recessions. And again, that has been inverted, which means that the 2-year yield is well above the 10-year yield. And, that again is suggesting that, a recession is looming. The Fed continues the path of removing liquidity. Just yesterday, the Fed announced another 75 basis point increase. That takes us to 3.75 to 4% target Fed funds rate. And an ongoing balance sheet reduction program of about $95 billion per month. So this is a removal of liquidity. And, typically speaking, all things held equal, when the Fed removes liquidity, that increases the cost of capital. Again, all things held equal. And therefore, that triggers lower equity valuations from a PE multiple perspective. And so that's what we've been seeing all year long, pressure that equities are under pressure, and therefore multiples have come down quite substantially this year. And again, I believe that is a direct reflection of what the Fed has been doing and saying essentially since February of this year, 2022. So, there's been a lot of talk lately about the Fed potentially pivoting where, they could be nearing the end of this interest rate hike cycle. I think that's highly unlikely as long as unemployment remains low and below long-term averages, and as long as the CPI as well as PCE remains well above the Fed's long-run targets. I don't think that the Fed is likely to pivot anytime soon. So I believe that the Fed is taking us to 5% and potentially beyond that. Which is kind of what the worst case scenario is as far as the markets are concerned. So I think there's plenty more to go with rate hikes. And even as rate hikes end, I believe that the balance sheet reduction program is going to continue for some time longer than that. So the Fed remains very tight, and that means that equity valuations are going to remain under pressure. At the same time, I believe that inflation expectations are actually decreasing. So this is counter to what the Fed thinks is actually happening. But in terms of alternative measures of inflation, such as the price action of gold, TIPS, the copper to gold ratio, as well as inflation expectations from the New York Fed, these are all very clearly in check. And even beyond that, other metrics too. Such as the GSG, that's the Goldman Sachs Commodity Index ETF, that's been trading below the 200-day moving average. Oil prices have come down substantially. Gasoline futures are down quite substantially. Wheat futures are down. Oats are down. A lot of other agricultural commodities are down. So these are not consumer prices, but they are, futures markets. So futures always lead what, the end consumer always ends up paying. But those leading indicators are well below their 200-day moving averages now. And I believe that those numbers are headed lower, generally speaking. So previously, in prior videos, I mentioned that the jury was out on whether this is due to supply catching up to demand which would be bullish, or if demand was softening, and that would be bearish. And now there's, very much mounting evidence of softening demand. So the latter is most likely the case, and sort of the culprit behind why inflation expectations are coming down. And we see this anecdotally throughout various different readings of the economy, as well as from commentary from management. If we listen to FedEx's earnings or Nike's earnings, these are two very important bellwethers of the global economy, especially, direct, players when it comes to supply chains. And both have indicated very, bearish commentary with regards to demand and excess inventory in the case of Nike. So there is mounting evidence both from management commentary as well as from economic indicators that demand is softening. The Chicago PMI, for example, is one of the most important metrics that I'm watching. This is not a leading indicator for the economy, but more so a coincident indicator of economic activity. And that's now down to 45. So that's, firmly in contraction mode. ISM manufacturing index is down to 50. That's not yet contractionary, but it's, the rate of change has basically went from, firmly positive to now break even, essentially zero. And I believe that that's going to continue to follow what the Chicago PMI is already showing, which is contraction. Factory orders and durable goods orders remain positive, but at a slowing rate of change. At the beginning of the year, those numbers were up, 8 to 10%, and now it's up, 5 to 6%. And I think that's going to continue the march down essentially to zero and ultimately negative based on what the Chicago PMI is telling us. And backlog is down as well to 51, which is the 30-year median. For all these reasons, I believe the top in inflation is in. And I think that the CPI will start to move down, and we'll see a little bit more as to why that is the case. And lastly, which is most important for investors, declining growth in S&P 500 earnings. We've seen this, throughout commentary from very important companies, that is sort of an indication of where the market and the economy overall is going. But there are now accelerating downward estimate revisions for fiscal year 2023. So, putting all of this in summary, there's two factors that are currently at play, which are both headwinds for the market overall. There is simultaneously declining liquidity, and that's driven by the Fed, and declining earnings growth. And I believe ultimately where this will shake out is earnings for fiscal year 2023 will be, at best break even versus 2022, meaning zero growth year over year. And the bear case is, 10% lower than what we saw in 2022. So I believe that the entire market drawdown that we've seen thus far is entirely due to a very normal repricing that reflects the new reality of interest rates. But the risk to earnings growth has yet to be priced in. And so the net result of both of these two factors, declining liquidity and declining earnings growth, should be lower equity prices. So my expectation for 2023 is for S&P earnings is roughly $210 to $215 per share of aggregate S&P earnings. And then if you put a 15 multiple on that, which is typical for recessions, that gets you a 3150 to 3225 target for the S&P 500. And today, as of today, it trades at 3735. So that gives us roughly 13 to 15% further downside to go, in my view. Now, the good news is that we're now closer to the bottom than we are to the top. So if that makes anyone feel better, that is, the case. But I do believe that there is, roughly 15% further downside to go from today's prices. And today is Thursday, November 3rd, 2022. And so here's the reason why I think this chart, which is very important to understand, here's the reason why I think that the entire move down this year is due to a repricing based on interest rates and not due to a repricing based on risk to earnings. So on the upper panel here, we see the forward PE multiple for the S&P 500. You can see that has come down quite substantially this year, and that's been essentially the entire contributing factor to weakness in stock prices this year is compression in multiples. And then take a look at what's happened to the equity risk premium. Now remember, the equity risk premium is very important to understand because this is the additional premium that investors require, which is implied in multiples over and above the risk-free rate. So in order for investors to take risk in stocks, there has to be the return that is provided from, say, the 10-year Treasury yield, plus an additional premium on top of that for to be compensated for the risk that you take owning equities over treasuries. And the equity risk premium is actually essentially flatlined, and it's actually down year to date. In fact, this is the lowest reading we've seen in 20 years, even above 20 years, almost 22 years now. And that would actually, in normal circumstances, that would actually be bullish for markets because as the risk premium collapses, investors require lower additional returns on top of the 10-year Treasury yield. And that's normally bullish for forward, PE multiples. You can see every single time that the equity risk premium has declined, say, for example, in 2013 and even into 2017, 2018, you can see that the ERP was in steady decline, from a very, very sharp rise, as in response to the great financial crisis. So typically the equity risk premium and forward PE multiples have an inverse relationship, which makes sense because the higher the premium, the lower the multiple. And this makes intuitive sense. Whereas right now we're seeing both lower equity risk premiums and lower multiples at the same time. So this brings us to the third panel right here, which is the total equity discount rate. So this adds the 10-year Treasury yield to the equity risk premium. So on a net basis, the total equity discount rate is up, and you can see that it's basically matching where we were at the bottom, nearly the bottom of the COVID crash in 2020. You can see the sharp rise in the total equity discount rate, in response to COVID lockdowns. And we're basically right there in terms of equity multiples, right? We're basically matching the lows of the COVID crash in terms of forward PE multiples. And this is coinciding with the total equity discount rate matching the highs of the COVID bottom. So this means that despite the fact that equity risk premium is now at the lowest levels we've seen in 20 years, that is being more than made up by the rise in the 10-year Treasury yield. So what this means is, my sort of takeaway is that this entire contraction is 100% due to the rise in the 10-year Treasury yield. This is in response to, the Fed's increasing of interest rates and higher inflation, as a sort of a result of that. So this means that risk to equities is not priced in at all. And if you look at the last panel right here, this is the actual earnings of the S&P 500. You can see earnings have plateaued here. The rate of change is quite significantly slowed. I believe we're at the cusp of this rolling over, similar to what we saw in response to COVID, similar to what we saw in response to 2008, 2009, similar to what we saw, in 2001 at the end of that, equity bubble that we saw there. I think that, this is about to start to roll over, and equity multiples haven't even priced that in yet because of what we see here with the equity risk premium. So this is why I believe that, essentially all of the repricing that we've seen in stocks is due to this new normal of, high interest rates, but not due to risk that is building within stocks, especially with regards to earnings growth. And we can see from, important indexes like the Conference Board's leading economic index, that's already a flashing warning sign right here. We can see that the index overall, which takes into account a number of forward-looking indicators, has rolled over. It's basically been, in decline every single month for the entire year of 2022. So again, this is flashing recession warning. Whenever, this index rolls over this much on a year-over-year basis, we have historically been in recession, or at least has, foretold a recession. Kind of like what we saw here in 2019, what we saw here right before the great financial crisis of 2008. Again, what we saw right before the dot-com bubble bursting and leading to that recession in 2001. So we're seeing a similar dynamic here today, being given by the leading economic index. Here is one of my favorite, indicators of recession is, the spread between the 10-year Treasury yield and the 2-year Treasury yield. Look at the track record this has had over the past 50 years. It has, inverted every single time ahead of every recession we have seen over the past 50 years or so. So this is a track record I would not like to bet against. And this is why I really believe that risk to earnings is really not being priced in. When recessions occur, earnings do contract inevitably. And yet I don't think, at least based on the data that I've seen, that today's multiples are a reflection of, risk to earnings growth. I believe that, again, it's entirely due to that, rising interest rate environment that we've seen. Chicago PMI, this is another one that's telling us that there's a risk to earnings growth. This has been forecasting declining earnings growth all year long. You can see the track record. The blue line is the Chicago PMI, and the green dotted line are S&P earnings growth year over year. And this has had a very strong correlation to one another. And you can see how much the Chicago PMI has dropped to date. It's now firmly in contraction mode. That to me indicates to me that we're going to see a decline in earnings for the S&P 500, 500 year over year. I think that's now an inevitability at this point, unless if we see a very sharp rebound in the Chicago PMI very quickly. I think that earnings growth is already sort of rolling over, but it's at risk of going negative, and I don't think the market is yet pricing that in. So again, production is clearly in contraction. The Chicago PMI, we already saw that here. ISM manufacturing index is following that as well. Very, very similar. These two, very similar information these two are sort of conveying. Now, this is the key here, is what's driving this. And we can see just anecdotally, these are just two examples, but there's many more. The upper panel, the upper sort of screenshot comes from ISM Chicago on their latest, update for the Chicago PMI. And you can see that weak economic outlooks are dragging on demand. So there's that sort of anecdotal, evidence there. And this screenshot is directly from the latest ISM manufacturing, press release. And, in there it says, quote, "In the meantime, demand eased with the new orders index remaining in contraction, as well as new export orders in index below 50% for a third consecutive month and at a faster rate of contraction." So I think that there's mounting evidence of softening demand. We actually even see that, for example, in shipping container rates. If you've been tracking that, I don't have a slide for that. I should have added it, but you can see that, the price of a shipping container, sent from Shanghai to LA has really just cratered. We saw that number rise in an epic fashion in 2021, going from about $2,000 to about $18,000 in a span of maybe 6 months. And now that index has basically round-tripped that entire gain. And now there's, sort of anecdotal evidence there that, they're actually having to send, containers that are half full. And that's what's leading to just a plummeting in prices. So there's, again, increasing evidence throughout the economy that there is softening demand. And, that's kind of showing now in the case of, corporate earnings that we saw already from FedEx and Nike. We're already seeing that, from, important chip makers like AMD and NVIDIA. They've already reported quite sharply softening, PC demand, shipments, for example, and that's a reflection of the consumer economy as well. So I believe that this is just getting started. And now we can see that, as, Q3 earnings have now come in for the most part for, much of the bellwether companies, we can now see analysts starting to mark down their expectations for 2023. So given all of this information that we've seen on a leading basis, like the Chicago PMI, like the leading economic index, like the Treasury yield spread, now finally we're starting to see the net result of that, which is lower earnings expectations being conveyed by the street. So this is the evolution of fiscal year 2023 expectations. This is the market cap weighted average of the S&P 500 earnings. And just about a year ago, the expectations were for $6.30. That was ratcheted up to about $6.50 as of April. And it's gone downhill ever since. And the rate of change has now accelerated as, analysts digest Q3 earnings. And I believe that is just getting started. This is the evolution of Q4 2022 earnings estimates. You can see that, as of August end, the expectation for growth year over year was about 2.5% for Q4 this year versus Q4 of 2021. That number is basically at break even now. So you can very clearly see the rate of change has slowed quite dramatically. And then if you remove energy from that, so if you remove oil stocks, right now oil stocks are what tech used to be back in, 2015, 20 to 2019. Tech used to be the source of all earnings growth. Now oil stocks are the source of earnings growth, because if you remove energy from that equation, then you can see that year-over-year earnings expectations are now at minus 4.2% year-over-year for the S&P 500 X energy. So we can see that if you remove energy stocks, we're already in decline year-over-year. And I think that is just getting started again. So, taking all of this into consideration, if we look at now the aggregate 2023 earnings for the S&P 500 X energy, we can see that it hit a high watermark of 2041. This is the aggregate earnings for the S&P 500 X energy. Don't worry about the numbers themselves, because this is different from what you might see quoted in financial media. But more importantly is the rate of change in this number. So again, it's been marked down quite dramatically here by about 10% so far, and this trend is only going to continue, I believe. So, what is the plan of action, right? So I've conveyed to you that I believe that, the combination of the Fed removing liquidity, and that is not likely to ease up anytime soon, and, leading indicators flashing recession warning signs, and therefore earnings growth coming under pressure, I believe that the S&P still has quite further downside to go, roughly 15% or so from today. So what's the plan of action? How should investors position their portfolios? And I think that, the answer to that is no different now than it is at any other point, whether we're in a bull market or bear market. And that is to focus a portfolio on companies with quality characteristics, own companies that exhibit very high characteristics. We want companies that have consistent revenue and earnings growth even through past recessions and other macroeconomic environments. We want to own companies with high business durability. That's the key there. We want to own companies that have consistently high returns on invested capital over time. This is very important because this accrues to investors in the form of higher dividend growth and higher share buybacks. As well as, an evidence that the companies that you're investing in are sitting on a defensible moat. Because if a company can earn a high ROIC for a very long time, it generally means that they have a very strong moat on their business. We want to, focus on companies that are defensive in nature. So companies that, cater to needs over wants. And then this is a nice to have, but not necessarily, something that is a must have, but a nice to have is consistent dividend growth, especially during markets where, returns may be muted. Dividends would provide some much needed income in order for you to, add, at lower prices. Also, what's attractive in a bear market is low beta companies that aren't really correlated to the broad business cycle. And lastly, companies whose returns have primarily come from growth as opposed to multiple expansion. Because remember, this has been the companies that have led to the downside this year are companies that experienced the greatest multiple expansion and therefore now are experiencing the greatest multiple contraction. So we don't want companies that, earned high returns due to multiple expansion. We want to own companies that have primarily generated returns, due to earnings growth. And that's very important to check out. So, the Zacks earnings certain portfolio. So I'm kind of, speaking my own book here. So the shameless plug here, but, as you might know, I am the co-portfolio manager of the Zacks earnings certain portfolio. This is a long-term, high quality oriented portfolio. And this portfolio is optimized for three factors, consistency, growth, and ROIC. And really you can apply that consistency theme to both growth and ROIC. So we want consistent growth and consistently high ROIC at the same time. So these three principles identify durable businesses. And this is often due to the presence of a very strong moat in the form of brand, in the form of network effects, R&D leadership, in the form of companies that have had the benefit of first mover advantages, or even companies that exist in a monopoly or duopoly. These businesses have demonstrated a very long track record of navigating exceptionally well through very difficult macroeconomic environments. So companies that have delivered consistent results for at least 15 to 20 years, if not more, and have, consistently earned high returns on invested capital. So who are these types of companies? Here are, just a collection of them. Very iconic businesses, companies that have existed for a long time. And, some of these might be boring, but, boring companies very often outperform the most exciting companies out there. And that's what's happening this year so far. Some of these are quite, well outperformers this year, especially, for example, AmerisourceBergen. They are the world's largest pharmaceutical drug distributor in the world. And, their shares are up again because their earnings are completely uncorrelated to the broad business cycle. Their earnings look a lot like this right here. So this is sort of the net results of the portfolio of companies that we've put together here. The blue dotted line represents the actual earnings results of these 75 companies that we own in the portfolio, as opposed to the earnings volatility of the S&P 500, which you see in the green dotted line. The green dotted line, I should say. So, we not only have better cumulative earnings growth, but we also have much less volatility of earnings, as you can see here, throughout different macroeconomic environments. And if you just think about how much the market has been through in these last 25 years, we've been through all sorts of crises and recessions and boom periods and high interest rates and low interest rates and quantitative easing and tightening throughout this entire time period. And yet these companies just continue to plow through all of that unfazed and deliver very consistent earnings growth. And the reason for that is because of high business durability and companies that have a moat and therefore can reinvest cash flows at very high returns on invested capital. So that is the core strategy, the methodology behind this portfolio. And these are some of the companies that we own in that high quality portfolio. And this is built to weather recessions. So exactly the type of environment that we're in today and will most likely be in for next year. These companies, I believe, will outperform on a relative basis versus the S&P 500. And so there's many more in this portfolio. So for further information, please do reach out to us. And again, I hope you enjoy this presentation. If you have any questions or any feedback, if I made any mistakes here, please do let me know. I'd love to hear from you. Please send us an email at zrs@zacks.com. Or if you are a Zacks Advisor Tools client, please send us an email at zat@zacks.com. All right, thanks everyone, and hope to see you guys again for the next one. Take care, everyone. Bye-bye.